Today, I'm going to help you to join the club of the thousands of informed homebuyers who have avoided these sneaky mortgage traps that we've unfortunately seen people fall for. So if you're in the market for a new home, or it's been a few years since you've looked into this, grab a notepad or save this video for later to make sure that you don't get caught in one of these sneaky traps. Because unfortunately, in this higher interest rate environment that we are currently in, we're running into these more and more as time goes on. So buckle up and let's dive into the sneaky traps that you need to avoid when assessing a mortgage. Sneaky trap number one. This is when you're only looking at the interest rate and ignoring the APR. This is an easy one to miss, mainly because most people don't know what an APR is. So let's cover that. What is an APR and why is it important? At its core, the APR is the true cost of borrowing the money on your loan. While the interest rate tells you how much interest you'll be charged on the principal, the APR includes both the interest rate and the other costs or fees charged by the lender. These fees can range from things like broker fees, closing costs, and more. Think of the interest rate as the base cost of your mortgage, and the APR is the all-inclusive rate. By looking at the APR, it's gonna give you a more holistic view of what you're really paying on an annual basis. The main place where we personally see this the most right now is when someone is shopping multiple lenders and every lender is just trying to win the deal and flash the lowest interest rate at you. And they're hoping that you won't look at the fees associated with the low rate. And you sneaky loan officers know who you are. So here's how I would suggest you avoid this trap. Get with a loan officer that will review your long-term goals with you, and they will also incorporate those goals when quoting you a loan. So for example, if you plan to own this new home for 4 years, avoid the loan officer that is just quoting you the crazy low rate with tons of closing costs associated. Because most likely you won't be living in the house long enough to recoup the additional costs that you paid to get that low rate. And instead, pay more attention to the loan officer's quote that more methodically stays in line with your goals. And yes, that may mean that they are quoting you a higher rate, but the fees associated with that loan may make more sense for you in the long run. This is how Mike and I quote and why we believe in quoting this way. And with that being said, let's dive into sneaky trap number two. Sneaky trap number two is being drawn in by the no-cost loan. This is clever marketing at its best. And this definitely falls into the if it's too good to be true, it probably is category. When it comes to the no-cost loan, at first glance, it's gonna appear to you, the borrower, that the loan doesn't have any closing costs associated with it. And closing costs, as you might already know, are the combination of expenses like appraisal fees, title insurance fees, lender fees, and so on that get done when you're doing a loan. And depending on the loan amount, these fees can add up to a good amount of money. Now, when lenders advertise the no-cost loans, they are not offering to foot the bill out of the kindness of their hearts. Instead, they are usually doing one of the following. First, instead of charging you up front, they may add the closing costs to the total loan amount. This means that you're gonna be borrowing more money than the actual home price, and you'll be paying more interest on the additional amount throughout the life of the loan. Or they could be charging you a higher interest rate. Some lenders may offer you the no-cost loan to give you a slightly higher interest rate than the prevailing market rate. Over the lifespan of your mortgage, this higher interest rate could cost you significantly more than the closing costs that they were originally covering. So here's what I recommend you do when you're evaluating one of these no-cost loans. And once again, I want you to loop back to your overall goals and look mainly at the amount of time that you plan to keep this specific home or loan. Then do a comparison of the no-cost option versus paying your closing costs up front. I want you to calculate how much extra you'd be paying in interest over the time period you plan to keep the loan. So for example, if you plan to be in the home or the loan for say 5 years, total up the interest for those first 5 years, then simply pick the option that saves you the most money. If you would like some help in calculating this out, drop us a comment below or click the link in the description below and book a call with us to go over your scenario more in depth. Now let's dive into our next sneaky trap. Sneaky trap number 3. In my opinion, this one goes to the interest-only loans. So real quick, let's cover what are interest-only loans. These are loans where the repayment terms of the loan require you to pay only the interest accrued on the loan, and you are not required to pay any principal on the loan for a specific period of time. In the last year, we saw come about a 40-year mortgage where the first 10 years were interest only and the remaining 30 you will be making the regular principal and interest payments. Now, are there situations where interest-only loans might work and be a benefit for someone? Probably, but here's why I am not a fan of interest-only loans. Whenever you take out a mortgage, majority of the interest total comes from the first half of the loan. This is because the interest is accrued on the higher balance that you are aiming to pay down. Now, in the case of the 40-year mortgage that we mentioned earlier, where the first 10 years of the loan only required you to pay interest only, the bank is just racking up the total interest on you, and you are not making any progress on the principal if you are only making the minimum required payments. And you should always aim to make progress on chopping away as much principal as possible. So here's my suggestion on how to navigate an interest-only loan. If you really need to get one of these for some reason, or you already have an interest-only loan, you must be disciplined enough to pay more than the interest-only payments. This way, you make some progress chipping away at the principal balance as well. Also, let me know in the comments if you agree or disagree with me on interest-only loans. And there you have it, 3 sneaky mortgage tips that you will want to avoid, as well as how to navigate them if needed. Overall, when it comes to mortgage loans, the devil is often in the details. It's crucial that you do your due diligence and understand what you're really signing up for. And as with any financial product, the best approach is to be informed. Ask tons of questions and always weigh the long-term implications of your decisions and base those decisions around your goals that you set for yourself for the long term. And as always, if you would like our help in financing your next home, or if you'd like to go through a more in-depth scenario together, check out the link in the description below and book a call with us, and we'd be happy to help. And if you found this video valuable, give it a thumbs up and don't forget to subscribe as we continue to bring you more great mortgage-related content. Have an awesome day, and we'll see you on the next one.